merger and acquisition attorney at the law firm of Dinsmore and Scholl. We are about a 700 attorney firm across 27 cities in the country. We are multidisciplinary, which means we pretty much serve businesses in any area of the legal services that they need. But I focus my practice on outside general corporate counsel as well as mergers and acquisitions. And in full disclosure, this is the first time Brad and I have ever done a presentation together. So we're going to work on this and try to make it as seamless as possible. But really the focus of today, I'm here to answer how your valuation may fit into a potential acquisition. But really, I'm going to give the floor over to Brad to tell you a little bit about who he is, because he's going to be the guy that's going to answer all your questions on the valuation itself.
And there will be a quiz.
But not.
He's very difficult. So my name is Brad Jadlowick. I'm a CPA at Kendall Sherry Line Associates. We're right down the road, actually. We service a lot of small business, closely held companies. We do a lot of work with individuals in tax and a lot of business tax planning and things like that. And I also do a lot of business valuation work for various reasons: estate, gift tax planning, corporate planning, loans for banks and things like that. So, and I'll be talking a lot about how the valuation process works and some of the really important critical pieces to that process, and going through some mechanics of it, but really just trying to give you guys a general understanding of really what it is that I do and why certain things are so important and how it all relates to each other.
So to kind of kick us off, I thought that we would tell you a little bit about how valuations can help play into what you're doing. And we really focused the first part of this on if you were selling your business. So we know that about 58% of business owners have never had a valuation done. And hopefully throughout the course of this evening's conversation, if no one's ever talked to you about why that's important, you'll get an idea for why that's important now. As Ann correctly pointed out, this also can be taken in the context of if you want to do growth through acquisition strategy for your business, why does valuations come into play for that? And really, the valuation is one critical puzzle piece to either doing a growth through acquisition or in selling your business. So we're going to talk a little bit about how that plays into that throughout the course of the evening. So to start us off, just some key purposes for valuations. It could be for your estate and gift tax purposes that you need to have a valuation done. And for each type of valuation that you have done, or for each purpose, evaluation that you have done, you're going to talk to your valuation expert a little bit differently. And Brad will get into this when he's talking about how he does this for you. But you really want to set the tone and tell them ahead of time, I'm doing this for a gift tax purpose or for an estate planning purpose. Or I am doing this to set up a buy-sell agreement with my other partners and with the other folks that are in my business. Hopefully you're not doing it for litigation disputes, so we're just going to put that one to the side. You could be for a marital dispute or equitable distribution. Again, put that one to the side, although I will tell you that from the time you set up your business, if you have other individuals, if there's more than one person in your business, having a valuation methodology for purposes of marital disputes and equitable distribution is incredibly important. It should be in your corporate documents. It could be for charitable contributions, or it could be for potential sale of your business in the future. So those are just some baseline valuation metrics for that. For purposes of tonight's discussion, we are really focusing on sale of business. And for that, I wanted to just kind of set something up for you, because I a lot of times get business owners that come in to me that I work with as outside general corporate counsel, and they will say, well, I know for sure I am X multiple of EBITDA. And that's what my business is going to sell for, because the guy or gal down the street sold for that. And I'm like, that's great. Now let's have a much longer conversation. Or it's some percentage or multiple of my gross collections for the last year. It really depends on the industry that you're in. So just to kind of take some of the mystery out of this, I represent a lot of financial buyers as well as business owners. So I usually work with them on their investment strategy, what they're looking for in businesses, how they're setting up a purchase price. Your valuation is not the same thing as your purchase price. It gets you a part of the way there. So one of the things, I'm going to give you an example of this, and Brad will get into a lot more detail when he talks about the valuation itself. When you hear people talk about EBITDA and multiples of EBITDA, what it really is a substitution for free cash flow. So what folks are really trying to look for when they're looking at purchasing a business is, what's that free cash flow going to look like in the future? And some of the things that they're also looking at is, what's the risk associated with that particular business? So a lot of the things that we're going to talk about this evening are not necessarily just what shows up on a financial statement, but also what are the other very individualized risk factors that come with it based on your individual business. So exit strategies, just to set up for purposes of valuation, a couple to think about. We have ESOPs, which is an employee stock ownership plan, We're not going to talk about that one tonight. The feasibility studies and the way in which that's valued is very, very different. That is a seminar in and of itself. Generational transfers. This gets back to, again, it does matter what the value of the business is, because a lot of times the folks who you want to take over this business, unless you're doing it for estate planning purposes and you're really gifting the business, you need to figure out if they have the resources, or if the company or they individually can be leveraged in order to buy you out. Or you have to consider seller financing, and if you do that, you want to understand free cash flow as well, because future free cash flow is going to determine whether or not you're going to get paid. Management buyout carries the same problems in an internal transaction as generational transfers, although it doesn't have usually the emotional connection that the generational transfer does, but valuation is equally important for that purpose. And then your external options that we're going to talk about is the third-party strategic buyer, which I touched on a little bit. A third-party financial buyer. So strategic, think of someone else already in the industry that wants to buy your business, either that already has a larger market share, or someone that you want to purchase because you want to increase as well. Or a financial buyer, we're talking about private equity groups, or someone that's purely buying you as a portfolio company. And the IPO, we're not going to talk about at all, because again, completely different valuation for that purpose. Or liquidation, we're going to ignore, because that's not going to happen to any of you in this room. So with that, I will tell you a couple of things. I said valuation is one piece of the puzzle. I always say start with facts and goals. So this is going to be my last piece before I let Brad really dive into the valuation part for you. There are a couple of pieces, and we'll connect them later. Your personal goals. So whether it is just you in the business, or it is 2 or 3 or 4, however many people own that business, your personal goals make a difference in what you're going to decide to do and how you're going to use that valuation to drive a purchase price. The business goals are also equally as important. What does that business need to do? Does it need to grow through acquisition before it can sell? The business valuation is a piece of it, because you need to know your starting point. So when people come in and talk to me and say, have you ever had your business valued? Have you ever met with your financial planner and figured out a personal needs analysis for you? Because what I usually hear is, I know my business is worth X, and I only need Y out of it. And I'm like, that is good information to start with. But if you've never had it valued, we don't know where to go and where is this good starting point for you. Because I don't want to just get you what you need. We want to get you what you want. So that's a really critical piece. And if you haven't met with your financial planners and you haven't done the personal needs analysis, you should also do that. And then in addition, identifying risk factors. And this is really where, in addition to the business valuation itself, things that maybe don't pop up in that valuation but are critical, you really need to understand what else puts the purchase price or the risk tolerance of the buyer, especially if you're doing a third-party buyer, in the mix. And those can be things like client concerns, client concentrations, or supplier-vendor concentrations. Anything in where you could lose 1 or 2 people and a lot of your money of your business goes away, a lot of your value of your business goes away, is a risk factor. If you have certain licenses or certifications where it requires a particular buyer, we know that your buyer pool is limited. Or, for example, engineering, we may need to find someone else that already has that license, or we have to figure out a way around it if you're going to sell the company. Market competition, regulatory are all in there too. And then transferability of the key assets of the business, I will get into at the very end. So with that, pass it over.
What button? Which button? Which one does it next?
That one.
Okay.
Yep.
Okay, so I'm going to get into a little bit more detail, like I said in the beginning, of how this valuation process works. What I'd like everybody to take away is just a general grasp on, we're going to go through these different approaches, okay? And it's very important to understand the valuation process is, in my opinion, a very critical analysis of each individual business, meaning there's no spreadsheet where your business fits in one or yours fits in the other, and we just plug your numbers in and go. It's very analytical, subjective at sometimes from the valuation analyst perspective, And there's just as much qualitative information that needs to be covered in addition to just the numbers. So the approaches that are part of the process are income, asset, and market, okay? And they may all apply differently to each individual valuation that's done, meaning the market may be more meaningful than the asset, or the income could be more meaningful than the other two. Sometimes two are thrown out and not all apply, okay? So I'm going to go through each of those in a little bit more detail, but I'm really going to focus on the income approach because mostly small, closely held business, Aaron hit the nail on the head. We're talking about free cash flow to equity, okay? And not that the other ones don't apply all the time or not considered, but I'm going to go into the income approach in a little bit more detail. So the income approach. Under the income approach, the methods are used to analyze the earnings capacity of the business. All right, so what do I mean by earnings capacity? We have all these different, in the next slide, all these items on the list are defined as income streams or benefit streams, okay? And they all can tell you a story on how this company's earnings capacity is. So we have net income before and after tax, we have net cash flow to equity, we have net cash flow to invested capital, we have earnings before interest and tax, and then everybody's favorite, I think, is EBITDA, okay? My personal opinion, I always rely heavily in my analysis on net cash flow to equity or net cash flow to invested capital, and I'll get to the differences in a minute. EBITDA is more or less a shortcut to the net cash flow to equity. Sometimes it works out to be very close, but it doesn't consider all the factors that could really weigh in on how a business ultimately becomes valued, okay? But it can be a shortcut to that. So that's why it's often referenced along with what Aaron mentioned, rules of thumb, multiples, and things like that, because it more or less is just a shortcut approach to that. So focusing on the two that I personally like to look at the most. So first is the net cash flow to equity, okay? Basically, what I'm saying by that is, I'm an investor, I'm going to put money into a company. How much money, what is the check in the mailbox going to be, okay? It's not how much money I can get out of it, including my compensation. It's how much am I going to get a return on my investment, okay? Because a lot of people will get into businesses, and yeah, they can make a very good living and buy in, but they're getting their paycheck, and they're not getting a return on their initial investment. So that's what I'm talking about. What do you have to, if you were sitting at home doing nothing and everybody paying everybody to run your business, how much, that's the money, your return on that investment. And then net cash flow to invested capital. So to define invested capital, specific businesses may be more leveraged than others, meaning they have debt. And in a more leveraged business, you will do an approach where you look at the total cash flow available to both the debtors and the equity. And sometimes you can actually have a better rate of return if you have a properly leveraged company. I'm not really going to get into that, but there is a specific difference, and the invested capital involves a more company that has more debt. So that's what I said before. Those list items are often referred to as income streams or benefit streams. So if I'm using those terms, that's what I'm referring to. Okay. Under the income approach, the benefit streams are converted to the value utilizing two methods, capitalization and/or discounting. So under capitalization, and I'm going to give an example of each, so once you see the example, it might be a little more clear. But basically, a capitalization is a single period valuation model that converts that benefit stream into your value, okay? And capitalization is typically is applied to historical values. It has to do with the past, okay? The other method is discounting. So it's a multi-period valuation model. It's applied to forecasts, okay? So why use one over the other? So if you're utilizing so when we're looking at your benefit streams, you want to pick the one, we want to select the one that is most representative of your business, meaning sometimes we don't need to do a forecast in a business valuation because you guys are steady Eddie. We're knocking out 10% net income every year. It's that, and it's going to be that in perpetuity. So the historics are a very good indication of the future, okay? So, and in that type of scenario, I most likely would just say, we don't need to do forecasts. It's not necessary. We can use the capitalization method to figure out the value. In other instances, you may have a company that's continuing to grow, okay, and then it would be necessary to do some forecasting and to analyze that data and use the discounting method to arrive at a value. And even in some situations, I'll use both. I'll calculate under the capitalization method and the discounting method because you may be in a spot, well, yeah, we have some growth, but the historics, they should, let's say right now the economy is great, okay? And construction is great right now, all right? So it could never look better right now, but the forecast could look good, but we know the economy is cyclical, right? So perhaps the construction will go back. It's going to go back down. So I wouldn't necessarily want to project a construction company in perpetuity with like 8% growth. So I still would consider that, but I also may do a capitalization of the historics and weight the two together in some judgmental fashion to kind of take a little bit from one and take a little bit from the other to kind of come up with a more reasonable value. So and I'm going to get in a little more detail about some of these items, but this is the basic capitalization formula. All right, I start off with my benefit stream that I've selected, okay? Net cash flow from equity. In this particular example, I apply a 5% growth rate because that's what the company's average is, what we've in the analysis of the financials. So I get a net cash flow for capitalization by applying that growth rate that we're assuming is in perpetuity. All right, and then I take my capitalization rate of 25% in this example, and I come up with an indicated value of just a little over $1 million. Talk about the capitalization rate. What is that? Think of it as a return on your investment. That is what it is. So I'm investing $1 million, and I want 25% return. Okay, that's what it is. And it is developed can be developed under various methods. But think of it this way. I have $1 million to spend. I can take $1 million, I can put it into treasury bills, get 3%, sleeping on the beach, okay? So I'm not gonna get I don't want a 3% return on a small business. They're risky, but they don't all succeed. I can take my $1 million, I can put it in the stock market. Now it's been erratic, but traditionally you're gonna make 8%. So I can take my $1 million, put it in there, and do nothing. Don't have to deal with employees, don't have to do anything. And then the next thing, so that's how we build that number. So I'm already at 8%. So I'm not going to invest in a company for 8% in a small business. Now there's other
Can we ask questions?
Yeah, oh yeah, go ahead. If anybody has a question, want me to slow down, let me know.
So net cash flow to equity, so just full disclosure, I'm an MBA finance.
Yeah.
Okay. So you're talking about, so when you take the cash flow of the company, you are dividing it into creditors and equity holders? Is that what you're saying?
Well, this particular is just to the equity. Now,
Are you saying this is an unleveraged company?
correct.
When you say unleveraged, nothing? Or just no long-term?
I mean, if they have like auto loans, then no. I mean, if they have a lot of equipment, they have lots of long-term debt, then I would look at it my benefit stream would be the invested capital. So all cash flow available to long-term debt and equity. You go through this pretty much the same motions here, and I come up with a total invested capital value. So let's say this was a highly leveraged company, and they had $5 million in debt. And based on the cash flow available to equity and debt, I have a $20 million value. Well, of total invested capital. Well, I take the $20 million minus the $5 million they have in debt to arrive at the equity value. That's kind of the process for that. So this example assumes that there's very little debt And it's basically interest-bearing debt and non-working capital debt, meaning lines of credit aren't considered in that kind of equation. It's just long-term debt. And typically, if people are financing cars at like 2%, that's, I don't really get it. That it's immaterial overall.
And so you're just assuming this is not a manufacturing
In this example, yeah, yes. If it was a yes.
So that cap rate then is the rate that the investor wants to make on his or her money? What that is?
Not necessarily what they want to make. So when I do the valuations, what I was going through before with the build-up method, 2%, 8%, and then there's lots of statistics out there on, okay, small businesses are more risky. So typically that could be another 11 or 12%. I mean, we could spend a week talking about that, but typically it's like 11%. Okay, so then I take my 11, add it to my 8, I'm at 19%. But then there's industry risks, there's specific company risks. So let's say this company has one customer. That's a big risk, right? So using professional judgment, I would apply I'd say, okay, maybe that warrants another 5% to get me to this rate. And then when all the product's done, you look at it for reasonableness, but that's kind of how this is what's all going through my mind as I'm doing this 5-line formula and developing these rates. So it's not necessarily what you want, it's just more or less like how I look at it, So you may say, somebody else might look at this and say, I don't want 25% on this. I wouldn't touch it for 30. It's not a want. It's more of my professional analysis and what I think it should be. Any others? Yes.
So you just brought up the point that it's very subjective. Do you recommend that business owners get multiple valuations?
No, just me.
Well, all right, so I will tell you what I was going to say at the end or the beginning. I don't know, but now it's right here in the middle. Typically, if no one has had a valuation done on their business already, I will tell them, and by the way, I already told Brad I was going to say this, that they go to a valuation expert and they say, can you do a calculation of value for me? They are much more cost-friendly, and it'll give you a good baseline for what your company's value is without getting a full-blown valuation. That is for the specific purpose of sale. So let me just caveat that with that. That is not for the estate planning purposes or litigation or anything else. Those you need written, documented, full report. They have to be able to be testified to in court. So completely different purpose. But for purposes of sale, if you go and ask the valuation expert, can I get a calculation of value? It is a smaller scope. They, like I said, they're much more cost-friendly, and it will usually give your other service providers the ability to go and start having conversations about what we think you can sell your business for or what you may want to acquire another business for without going the full-blown valuation side. Because as someone who represents financial buyers as well, I can tell you, depending on the industry that you're in, even if you've had a valuation, that's lovely. They're going to do their own. And they're also going to do, when you talk about manufacturing companies, they're going to do their Q of E, which is their quality of earnings, which is a whole different side of what they're looking for. But valuation concept basically for a purchaser from the legal, when we're talking to the business team internally and a financial purchaser, they're really looking at what they want the future projected economic benefit to be, dividing that by some rate of return, encompassing in all of the risk factors that may affect that rate of return. So there's a lot more that goes into just the numbers and the valuation, although the valuation is critical. But hopefully that answers your question, calculation of value. Maybe pick that first.
Yeah, and I have done that for a lot of people. Like, I won't even issue a report in some cases. Like, I'll have a client come in. It could involve estate planning, but they're not quite ready for it, and they just want to get all right, my estate's around, I don't know, 19 million bucks. I don't know what my business is worth, but I may, just want to get an idea for down the road, and I'll do the math. I still have to do the analytics, but I don't have to write a report, which takes a lot of time, and a lot's in there that, quite frankly, none of you probably even care what it says, but the lawyers, sue me over stuff if I don't put it in there. But I'll bring people in and I'll do the math and just say, hey, I think this is right. It's just like an oral presentation, no report's written, and that can save you significant dollars. And in a calculation engagement, we would say, okay, this thing really depends on just the income approach. So I don't do any analytics on any of the other approaches because they don't really give you the highest and best value, okay? And that's really what you look at it, okay? So where are we at? Okay. So this is a very basic formula, okay? No bells and whistles. Yes.
On the net cash flow, when you have contracts, long-term contracts, 4, 5, 6 years, how does that fit in? Is it in the capitalization rate, or where is that coming in?
Well, so if you have, it can play into the capitalization rate if there's a risk involved with those contracts. You may want to have that they may not repeat. Okay, so if you came to me and I say I have contracts that are good for 5 years and I have nothing after that, nothing's coming up, then that would obviously maybe be more risky of an investment if I'm buying a company and all the contracts are expiring. But if you've been in business for 30 years and you're constantly getting new contracts, then maybe it's less risky. That kind of stuff comes in more with forecasting, which I'm going to get to in a little bit. Okay, so let me go to the next example, and then we can do more questions. The next example is just going through the process of the discounting of net cash flow. And all we're really doing here is we're using the discount rate, which is based, just think of it as the cap rate. The cap rate is just discount rate minus growth. So this is kind of an inverse of that. And what we're doing is we're saying, okay, so we did a forecast here. We have 2019, 2020, 2021, and I'll get to TV in a minute. So the $100,000 in cash flow you're going to get in 2019, I know it's 2019 now, this is an old formula, is not worth as much as it is today. So we have to discount it back to the present value. So it's a time value of money concept is what this formula is doing, okay? So it's taking my 100, saying, okay, today it's worth 80, all right? And then for each year, we do that. And this TV stands for terminal value, okay? So when you're doing a forecast, you need to stretch your forecast out long enough to capture all cyclical cycles in your business, okay? You want to stretch it out 3 years, but every 4th year we have a huge drop-off in revenue, and then 5th year it picks back up. So I'll get to that in the forecasting. But with terminal value, basically, is I had to write this down, is the value of the company's expected future benefit beyond the period of projection. So this is the value of all future periods. So you have to end it at some point. So there's a mathematical equation to do that. But going through this, the 100,000 in net cash flow with some growth, this value would come to 592. So basically, between the two differences, capitalization and discount really has to do with historic and future. So before you even so I wanted to show this up front, but before you even get to this point, the most important thing really that happened is really the financial analysis of the historics and the forecasting, because this is all garbage if we don't figure anything out, if we don't really analyze your historics and the forecasts. So, and what I mean by financial analysis is just a general analysis of the financial statements. I look at common size, I look for trends, I look for just weird inconsistencies, I compare it to industry data, how do you look to your peers, things like that. Well, boy, your cost of sales are really high, things like that, and we go through that kind of process. Most of you guys maybe keep your books on tax basis. A lot of times I got to take them from tax to GAAP, okay? Because tax basis, nobody has any income, right? And then on GAAP, that's when you want it. So we have to go through that process of maybe converting your internals, which sometimes can be painful because people will have to pull AR and AP and get a true GAAP, because GAAP statements are the true economic picture of your companies.
Well, here, so I'll give you a little backing on that one too. So for GAAP, I always say the devil's in the details with your purchase agreements. A lot of times, and we do have people that agree to do historical financials, and we specifically state they are not in accordance with GAAP. Everyone knows this going into it. So, I have bought and sold businesses before that just have said, this is too difficult, we've been in business for too long, we haven't been doing it that way. We're going to be upfront about it and tell everybody. And you have to come to a lot more agreements along the way as to what each line by line item means then. Because the typical default will be all of your financials will be represented in terms of GAAP. You will be repping the whole way through, this is in accordance with GAAP. What that means for you in a transaction if you're selling your business is if the purchaser gets into your business and realizes something isn't in accordance with GAAP, and there is a financial downfall for that from them, they will say there has been a damage, and then that leads us into indemnification claims and clawback of the purchase price based on the fact that they now have a claim that it wasn't in accordance with GAAP. Inventory, you said manufacturing, so now I'm kind of honed in on that. We've had this dispute before on inventory in companies that, what was it obsolete? What, was it in accordance with GAAP? Should it have been there? Should it have been reduced? So all of these things start triggering. That is a seminar in and of itself, but it does become a very critical point within the deal terms and the actual deal documents that can claw back your purchase price if it's not done appropriately from the beginning.
Yeah.
Oh,
You guys are up.
It's the general accounting principles.
It means generally accepted accounting principles, GAAP.
And there's some wiggle room in there. So, and this is all I will tell you. So inventory, that example. Post-acquisition dispute, two different experts will both tell you that GAAP is slightly different with respect to the exact same inventory. So it really is a science in and of itself, but for the most part, most folks will agree on what it is in accordance with GAAP versus if it's just been kept on some other basis. But I will tell you there's still some wiggle room in there.
I mean, to think of it simplistically, just think you have cash, you're going to capture your non-cash transactions, what people owe you, what you owe people, okay? On your tax basis stuff, that's not on your financials, and that can be very, very important. You may have people owe you $100,000 in accounts receivable, but you may owe people $1 million in AP, but you might have $100,000 of taxable income on your tax return. So it all could tell, it's a better story about the economics of your company. But that, like I said, that could be that line we could talk about for an hour and a half on how to get there. Anyway, more importantly, yes.
So the reason, the overriding concept is that when people ask you to do their taxes, to do their tax returns, they're using a cash basis or they're doing using other accounting because you have a different purpose. Most people, when they're doing tax, want to save money. They want to report the lowest amount of income, especially if it's an S corporation or a limited liability corporation. When you are doing valuation, you want the valuation to be the highest number. So you want your income to be the highest you can show within generally accepted accounting principles.
Yes, yeah, they're two total opposite goals, right?
Same thing will come into play for normalization.
Yeah.
So we'll talk about that as well.
Yeah.
It's why people pull all the cash out at the end sometimes of their business at the end of the year versus leaving it in there if you want some historical.
Let's not get too scared about that line. So really, the next two things I want to talk about is the normalization and forecasting. So what is normalization? It's basically a cleansing of your financial statements, okay? All right, kids on payroll, wife's car, condo, it's all on there, and it needs to be cleansed so we can get the real economic basis of this company. All right. So here's the common adjustments. Number one is officers' comp. Okay. You as owners may get paid very, very well. Let's say you're a C corporation. Well, typically you pay all the profits out in wages. You may have a $500,000 salary, but what you really do for your business from an economic standpoint, if you had to pay somebody off the street, it might only cost you $100,000. So right there is another $400,000 in profit, right? So we normalize that. We go out, we go and we analyze, key people, officers, what they do and what they don't do, and we add that back to the bottom line. Other payroll adjustments, non-working family members, your 10-year-old that helps you all summer and gets paid $50,000. Rent expense, okay? You may own the real estate and play tax games increasing your rent, okay? It may not be fair market value. You may be paying way, way more in rent on your books versus if somebody else owned it and what they would charge you. And all these things, when I go through this process and I ask people if they're not already a client or I don't have a relationship with them, it's like it's like pulling teeth, and I have to remind them I'm not the IRS because most of these all involve bad tax things, okay? So I have to just, I was just doing one for somebody like, why are you asking me all this? I'm like, well, do you want it to be worth more or not? I know you have all this in there.
The buyer will find it too. That's the other thing I will tell you. Separate and apart for you wanting it to be valued higher, your buyer will find it. They will find things that your valuation expert didn't even find, and then you'll be arguing about it and figuring it out and negotiating what it really should be. So they will find it.
Because when I do with your data, I compare it to industry. Okay, and industry data that I get is based off public companies, and they're all very, very honest. Well, they're supposed to be. So so that's where I start gauging what makes sense and what's not.
Did you say you're comparing privately held companies to the results of publicly held companies?
Some of the data in the statistics.
The question was, I'm asking him if what he just said was that he's comparing financial results from privately held companies with publicly held companies.
Yeah, there's public data in there. There's also private data. With some of the sources of industry statistics I get, it's both. It can be both. That's why you have to be very careful about using it. You have to know what you're looking at. So.
Keep in mind too, public companies run the gamut, which I know you already know, but public companies run the gamut. So you can have a public company that is very close to having a privately owned company. We've had privately owned companies that have gone public and gone private again with PEs buying them. So you can have a company that sits very similarly situated to a private company that is indeed public. So it depends. Yeah, it depends on who.
Most of the people that you're dealing with are privately held companies.
Yes, they're all privately.
And so that it's such, they're so different.
A lot of everything that goes into the valuation, a lot of the data and analytics when it comes to cap rates and developing those, it's all off of public company analysis because it's held out to there to be because they're held at a higher standard that their data is more pure. And so, there's just not all of you are turning your monthly financials in to have it compiled in a database. So there's, but it's a guide, not like, oh my God, theirs says this, you have to be that. It's just to get it going. So a couple others, automobile, travel, wife's car, vacation, that might be in there. So those are all add backs to your bottom line. We have non-operating assets, what's that building down in Florida, okay, and so that's removed from the books and all expenses from it and income has to be, it's a cleansing process, okay. Excess cash, I have companies that have so much cash, I don't know why, which isn't a bad thing, but they don't need it, all right? They may only need $100,000 in their bank account to operate, but they got $2 million for whatever reason.
Don't keep excess cash.
No, it's a bad idea, yeah. And there's many, many, many more that we could go into. But these are some of the main ones and really the ones I go to. Other ones are meals and entertainment. Do you need the box seat? Do you need the Penguin tickets? Maybe you don't. They could have a very good business purpose because maybe you do take a lot of clients. But a lot of times maybe not. Let's see where I'm at. All right. So the next, any questions on that, or we can wait till the end too. Forecasting. Okay, I think we all maybe have a general idea, but basically we're taking, we're prophesizing the future based on what we know today. Okay, so we have 4% growth. We're going to hire somebody. We're going to do this. We're going to build a forecast. Okay, and then we have to do the forecast if we're going to use the discount approach. So often this comes up. Like I said earlier, if you're not a steady Eddie company, or maybe you're a company in growth too, and you're going to level out some years down the road, we'll want to use the forecast as part of our valuation to come up with those benefit streams to come up with the value. Because the historics may not tell the truth on what the future is going to be. And in the forecasting process, I like, and this, a lot of times the clients will do this, okay? So they'll give me a forecast, and it looks nothing like last year, okay? So a lot of times, because forecasting is really, it becomes a part of the valuation engagement. So, but it's not valuation work, so to speak. So I have to take it and check it for reasonableness, because a lot of times all of a sudden, wow, you have 10% growth over 4 years, and cost of sales dropped 10%, and you've never achieved these results ever, or even trending that way. What's going on? And maybe they have a good reason, maybe they don't. So again, I have to kind of go through that And, a lot of times getting the normalization of the historics out of the way really helped pave the way for this, because obviously we don't want to forecast expenses that don't apply. So a lot of times I do a lot of hand-holding in this, a lot. Because obviously, if, how these numbers come out, if they're not accurate, then the whole value is blown off. So this is extremely important. Doing the math on the discounted future cash flows is nothing. It's getting to that number that we use in it. A lot of times people go, how many years to forecast? I kind of mentioned it before. You want to forecast your data, your financials out in a long enough period where it would capture any types of cycles. If you're up and down, a little cyclical, you want to get through the peak and the valley, okay, until it kind of levels out, or at least captures a whole cycle, or at least to the point where you have, where you think it'll steady out. So typically it's between 3 to 5 years. I mean, if you're going 20 years, you're getting a little ridiculous, okay? So typically 5 years really is the most I've seen. In forecasting, a lot of times people will have good growth, but they leave out things like, boy, I'm growing at 5% a year. Well, that could be great, but are you considering, well, I'm going to need to add another person, buy another piece of machinery? Boy, my warehouse is only so big, I'm already at capacity. Okay, so all this, have enough working capital to make payroll, to pay your bills and things like that. Because as you grow, all those other things can become more expensive. So a lot of that needs to be considered, as a lot of time it's just neglected because it's not being thought about. Let's see. Okay, and so I'm just going to touch on the last couple approaches just pretty briefly here. Under the asset approach, we analyze the individual assets of the balance sheet, okay? A lot of this won't apply to some small businesses, okay? Because it's really based off of income. Let's take a law firm. They have no assets, okay? They have computers and desks. They're worth nothing when it comes to this stuff. So this approach, I wouldn't even look at. I'd put a note in the report, doesn't apply, and that's it.
People, whatever. It's all good.
It's a people place. But these are the kind of, well, actually, I take that back. That was a bad example. That was, we'll say a CPA firm, okay? It would be a better example, maybe even. I have applied the asset approach in a law firm, actually, and it had to do with a contingent law firm, okay? Using this adjusted book value, which basically we take your balance sheet and we adjust all the assets on there to fair market value. Again, remove the ones that don't belong, and then adjust the other ones to fair market value. So that would be like receivables, work in progress, process, and things like that. Typically, this is more in a really capital intensive. You might have manufacturing where this is meaningful, okay? They have tons of equipment, okay? So CNC machines, that kind of stuff. Liquidation, we don't want that. And cost to create, meaning to replicate this, what would it cost? Typically, the last two. Well, the middle one you don't want, and I've never really applied the third one.
Brad, how does the intellectual property you have patents?
Well, I actually personally haven't done a lot with IP stuff, but I would imagine if you own a patent, knowing what I know, owning a patent and having possibly royalty streams off of that, you look at that, okay? And that would come into play. Personally, I have not done a lot of work in that, so I can't really opine in good detail on that.
So
Do you have you worked in a lot of
yeah,
that?
so I'm not going to get into detail of the valuation methodology because I am not the valuation expert. I know my limitations. I can read them. I can work with the valuation experts for the purpose of why we're looking for them, and I can certainly work with folks as to how we can manipulate purchase prices around what the valuations say. That said, it depends. So if you're talking about an IP in an established company that's had cash flow for many years and is cash flow positive, that is a very different conversation than if you're talking about IP in an early stage company. That valuation methodology is entirely different than what he's talking about here because most of those companies don't already have any type of cash flow or revenue flow. So that is a very different valuation methodology that's not touched on through this evening's presentation at all. So hopefully that answers that. Okay.
We have some time to remind
The last one, the market approach. This is actually very important, even to small businesses, okay? So basically, under the market approach, there's the main two methods. You look at publicly traded companies, okay? You literally look at what maybe they're trading for, okay? And try to apply it to yours. But typically, if I am using this method, I use a transactional data approach. Meaning I look at other transactions, I have access, there's data out there all over the place. And I look at these transactions of sales of companies like yours and whether they sell for, whether their numbers look like. And I develop pricing multiples off of that. So in this situation, I may take a multiple from maybe analyze, I try to find, there's thousands of transactions, right? And I'll go down the line and I'll compile, try to get good comparable ones. And like the data is sometimes the data is really good. Sometimes it's missing the entire income statement, just a price and a couple multiples. It just all depends on how much is reported because it's all voluntary on a lot of those things. And I'll take that and I'll apply it to your company. So if a company sold for, let's say, 2.5 times EBITDA, I'll apply it to your EBITDA, okay? And come up with a value that way. I'm big on revenue, okay? Top line number for multiples because it could be the truest number. Because when you get this transactional data, I don't know what they had in cost of sales. I don't know what officers' comp was. There could be a lot of garbage in there, and it'll trickle down to the EBITDA. So a lot of times I like to work off the revenue multiple just because I think it might be the purest number on that kind of data. And I'll take that and apply it to your revenues. And a lot of times too, because even the IRS wants you to look at this stuff when you do stuff for estate and gift tax. It needs to be considered because we're looking at transaction, people willing to buy things, okay? So it has to be indicative on what companies are selling for. But because of the mishmash of data that you may have, I don't think it can be the end-all, be-all. So oftentimes I'll do the income approach. If I have some good transactional data, I'll apply it and I'll wait. I'll do a weighting of the values to come up with the overall value. I think you're up. Oh, wait. I have one more. Sorry. So, again, these are the methods. I mentioned the guideline company method, which is really hard to apply, okay? I can't apply a small local garbage company to waste management, okay? They're an $8 billion company. And then, sometimes there's sales of company stock, okay? Meaning you've had internal sales. You can consider that. It depends on how that was done. And even rules of thumb, okay, that's based off of market data, all right? Typically, like, the rules of thumb I use is sanity checks. I mean, they're not completely pie in the sky, but after I come up with a value, I do say, okay, well, what's the rule of thumb? And if it's, like, way, way off, then I'll go back and look at my own work and try to reconcile the two, okay?
Okay. So remember way back when I said it's one piece of the puzzle? So now that we've gone through kind of how he gets to the valuation, I will tell you, I'm going to go through some maximizing value and value drivers, but this is all very business specific. So this is where I'm really telling you, you could come to me and say, hey, I've already had a calculation of value done or valuation done, and I really think my business is worth X. And we can use that as a starting point. I will tell you, there are business owners that I have worked with that have come in and have already known who their purchaser is going to be. And this is for a third party. This is different than internal. I said there's internal and external. But I already know who my third party external is going to be, or I know it's going to be one of these three. And now we're dealing in a very different ballgame because those folks are valuing you for a very specific reason. It's usually a strategic purchase or a financial purchase. It's going to be in the ballpark, but they're going to use that valuation as a piece of calculating a purchase price. So how they do that is not going to be down to a science. I will tell you, you can look at ranges. Because this question's already come up, there are services that we can all use for private companies that'll tell us roughly what the multiples are. It's hard to gather that data with a high degree of certainty unless you're looking at really large privately held company sales. And the reason for that is they're just not reported. I will tell you, I've closed 4 transactions in the last 2 months, none of which am I allowed to talk about purchase price or valuation or purchase price calculation on. All the terms of the deal are confidential. Nobody wants to disclose them. They'll tell you that the acquisition happened or that a divestiture happened, but nobody's talking about the specific terms of the transaction. I can't report that to a place like PitchBook, which PitchBook is one of the places where a lot of the data goes into, and we can all look at what multiples are. So there is some of that data, but it's not widely. And again, if I have 3 different buyers, they may want to value this company 3 different ways. It's not his valuation, the specific valuation that you have, but the purchase price calculation, what they're willing to spend. They use that valuation for a baseline. So from a business context now, forget about the specifics of the valuation. What we're getting at is how much is that business how much do we have to buy it for, and how much additional working capital are we going to have to put into it to do whatever we want with it to get it to the place where it's making money for us. So a lot of times, especially when I'm dealing with strategic or financial buyers, what we're looking at is not only how much money we're coming up with at closing, but how much additional working capital we're putting into the company from day one. So we're coming up with 2 different numbers. So, these are used as one piece of the puzzle, and that's where I just really want to focus in on that. Also, for your determination, and I'm focusing this all on your sale of the business, we can certainly talk about whether you're determining if you want to acquire a company. But on your sale of the business, purchase price is only one detail in the sale. Everyone gets lost in that detail. And I know it's a very important one. But believe it or not, when you take those other factors that I mentioned, your personal goals, your other business goals, what you really want out of this, financially and otherwise, a lot of times you end up with a deal. You may have 3 buyers on the table, and you say, I'm going to take deal B, not A or C, because it has the overall deal terms that I want. That can be things like mitigating the risk on clawback of the purchase price. So I don't have as long of an indemnification on the buyer saying that they can come back and take some of my purchase price back. They're not holding any of my money back. I'm getting it all at closing, or I'm getting it all within a short period of time. Or for some companies, they actually want 2 bites at the apple. So I've worked with a lot of CEOs that say, I want to sell a large piece of it, but I want to stay on for a period of time. This happens a lot in the context of selling to a private equity group. I want to stay on for a period of time, and then when that company grows even more, when they sell it, I get my second bite at the apple because I get to participate again. Or with a strategic buyer, I want to go now work with that strategic buyer. I've had a strategic buyer from California buy a West Virginia company and open a whole new division that my CEO then ran and got equity interest as well as purchase price in the larger strategic from California. And when that eventually gets sold off, which they will do, or they do an IPO, they'll get the benefit of that. It really depends on personal interest from that. So keep that in mind when we're talking about maximizing value too, because again, industry specific, your business specific, but hopefully this will answer your question on long-term contracts. Somebody had that back there. So I put up some examples just so that we could walk through them. Folks could ask questions and how does this affect me? And this really goes into more of, again, you have your baseline valuation. This isn't going to directly affect what Brad's doing, but it will directly affect purchase price and what's going to happen with the overall value of your business for a purchaser. And also, by the way, if you're looking through growth through acquisition, depending on the industry, what you should be looking at. So diversifying client base, we touched on a little bit. I'm just going to talk about diversification in general. When I look at a company, and it is very specific on particular customers and clients, I always say, what are you buying or what are you selling? So depending on who I'm representing, right? The baseline question for me is, what is it that you really want? What asset do you really want to buy? So I know that goes against everything we just talked about valuation. But for example, a company may tell me, I want these 10 long-term contracts. We are a strategic buyer. It is very important that we get these 10 long-term contracts. If a company only has 3, and the largest portion of their revenue come from 3, if one of those goes away, that's a very risky purchase for a buyer. So to increase the value and the attractiveness of your business, a lot of times what I'll work with business owners, is there any way to diversify? Can we work on getting a few more larger contracts? Or is there a way to protect that revenue stream so if you only have those 3 and you lose one, it is not so detrimental to the business? Can we make you more attractive to buyers by diversifying that client base? Same thing goes with vendors and suppliers. Sometimes it's important, sometimes it's not. Sometimes you have, the most premier vendors and you need to be on a particular, or you need to have a particular supplier list, have those things happen. So diversification can be one way to do it. Protecting intellectual property. So a lot of times there are things that are patentable or registrable, even from a trademark or copyright standpoint that have not been done. Can you do it? Have you done it? Is it protected? If you have protected it, are you following up on it? because a lot of times there will be infringement. If you don't act on that, then you have a hard time enforcing it later. If you do have intellectual property, have you done things internally with your employees to protect it? Do you have the right proprietary rights agreements? Do you have the right restrictions in the agreements with them so that they know that the company owns that? Because I will tell you, when I do diligence, or anyone does diligence on a company, in order to purchase it, one of the things that we'll be looking at is there any wiggle room in these assets for them to go away? So if those assets are intellectual property and I think an employee can claim that they have it outside of the company, or they're free to compete with you and take it outside of the company, I'm going to immediately tell my client that's a red flag. We need to talk about that and see if that lowers your value of the business. And same thing, restrictive covenants and incentive plans. Are your employees, if they're going to be important for going forward, are they already incentivized to stay? Are restrictive covenants okay in your industry? I will tell you they are not okay in every industry. I would love it if they were. It makes my job really easy to tell my clients, we're going to tie the hands up of everybody, and it'll be great. They'll be here. They can't go anywhere. They can't compete. Some are very industry-specific. Folks just won't accept them, and that's okay. You can work around that with other incentives. I just had this call earlier this week with a client saying, how can we incentivize our folks so that we don't have this turnover and they have a new significant project that's going on? And so we're working on incentive plans with them, ways to just give those employees more reasons to be loyal and want to stay. Management changes. So one of the things that you also need to think about is your management team important to a potential buyer? And if so, is that management team going to be in existence? If you don't have the right managers in place, equally as important. Do we need to hire someone? Do we need to find someone to continue operating this company going forward? Some folks will want to come in and put their own management team in place, so that's not going to be important. For other potential buyers, they really want a fully operational management team. So do you have all the right key people in place if you need them and going forward? The improving business performance is measured by industry metrics. That's all Brad. So he went over a lot of stuff with you before. But do we really need to look at the industry metrics and say, hey, we're not really meeting it? So that's one piece of the valuation that if you get a calculation of value or a valuation done ahead of time, we can look at and say, is there something that we can help you with on that? Same thing with paying down debt. May be important, may not be, but if there's a way to pay down some of the debt so you have some more free cash flow, you may have time to do that. The addressing contract terms or warranty matters. So this goes back to, again, devil in the details, what I was mentioning. If contracts are important, and I ask somebody what's the asset you're looking at contracts, now I start looking at other things. Are there warranties and limitations, liability into it? How much liability are we taking on as a buyer, right? And I'm doing this on the basis of me looking at it for buyer, but you get where I'm going with this. How much liability do we have to take on? Is it risky? Do we need special indemnifications over warranties that are long-standing because they weren't otherwise running the business how we might have run it if we were running it? Termination provisions in contracts. Can this contract terminate easily within 30 days? Because if so, we really have to look at that from a value standpoint. Or is it something where we know this is a long-term contract and it's very difficult to get out of? That can work for or against you, right? If they want a long-term contract with a client and you have a long-term contract, that's great. If you have, I sold a company before where they wanted the intellectual property. That's all they wanted. So one of the things that we did, we knew all our strategic buyers were going to want that intellectual property and they were not going to want to be tied into any of our revenue producing agreements. So we were not selling this company based on the revenue that it produced. All they were going to want was to take that tech and add it to something that they had. That was the highest price tag across the board. So what we did painstakingly for about 3 years before that was get into all new contracts, of which company selling could get out of like that if they sold, because we needed to. And we needed to have no financial detriment to the company if we wanted to get out of those contracts. So that's why working with, whether it's it should be an attorney. I'm just going to throw that out there. Well, I don't care what attorney you work with, but if working with a good M&A attorney that can kind of work through those options with you is really important ahead of the game, so that you can work through and see where you can maximize value. And they really should start with that question of, what are the key assets for your particular business? What are you selling? Who are the likely purchasers? And if you decide to work with another intermediary as well, whether that be a business broker or whether that be a full investment banker, they will also walk through those things with you and with your law firm. But what's really nice is when all of these service providers, because that's what essentially we all are, we're here to serve you, are working together and can talk together and explain how these things work in conjunction with one another. Because you're right, we can call the valuation expert and say, this is the particular purpose that we want this for, and by the way, we want you to make these assumptions when you're going through the valuation within a range of where they can still do it with their license and be okay with that. So they will tell us no or yes, but we can at least give them some assumptions to work with.
The next slide I just added was it's the same slide basically before, but just to kind of give an idea what adding, in this particular case, I say after increase of value driver, this value driver would be revenue. In the previous example, we had 250,000. Now we have added 100, and you can see just by adding 100,000 to the bottom or to your net cash flow, you can have you can see that there could be significant increases to your value. So all these things that she's discussing and what we've talked about, if you're trying to add value to your company, part of it, a big piece of it is revenues, okay? And, you can see here that you can start really increasing your value. So like even now I'm working with some clients that have had their tax hats on for 15 years, but now are thinking about selling their business. I'm like, well, you've never had a profit. And they're like, well, And so, now all of a sudden we're wanting to, get some years under our belt because, you're going to start wanting to set the trend. So all those things are important. So if you're getting to that point, you may want to start talking with your people that you consult with and say, hey, how can we start, generating some value here? Yes.
So when you're looking at the cash flow and equity, or you're forecasting to come up with those numbers, and then you're looking at the assets that are making that revenue stream, is that all comes together at the breakdown, the capitalization rate? I'm getting confused because I've got assets, I've got cash flow, I've got capitalization.
Well, yeah, I mean, the cap rate is based on, okay, on this particular type of entity, this is the return I think it would warrant, okay? So that's all that is, okay? And it considers risk. So if you had all these contracts that were all cancelable within, on demand, okay, that would be a risk, okay? So that would be captured in the cap rate, okay, that kind of stuff. But all those assets, you need them to get your cash flow, okay? If you don't have those contracts, you don't have the cash flow, right? So it is encompassing some of those values, okay?
So that's encompassing.
Now, if you were saying I want to sell 10 contracts, or you're selling a division, then this is a whole different process. Like, I have a client approach me, hey, we're thinking about selling our company to a buyer. Well, that's a different standard of value, meaning if I'm consulting with them, the buyer's going to take their client base, but they don't need their staff, they don't need their building. So I wouldn't go through the complete same process. I would say, okay, you're basically taking their revenue and their cost of sales, okay? And that value would be significantly more versus if I was hey, I'd like to start up and run a company, I'm going to come in and buy it. I couldn't pay what that company could pay. So there is some significant differences with the goals that you have, okay? The examples that I've gone through are this is fair market value, okay, which a lot of time is used in estate and gift and things like that. But investment value would be different.
Deal structure drives a lot of it too. So, depending on whether you're doing this in internal transfer, because sometimes for an internal, right, one of the ones we talked about was generational. We'll have people give a portion of the equity for gift tax planning purposes, and then a portion of it will be purchased. Sometimes people do seller financing. So that's where I said having folks working with you on what that deal structure is going to look like potentially. What are your transition strategies? What are your ideal transition strategies? And then let's fit all of the other folks that are going to offer services in, knowing what that is. So I do think it is very important for you to kind of walk through with saying, hey, we're thinking about doing X and Y. Can you call someone and help me get a valuation or calculation of value that works for this process? Because then those folks can kind of talk, they should at least talk to each other and say this is the purpose that we want it for, and then the exact methodology that's used will be specific to that and specific to your business. It's important to do that.
What about valuation of a business investor that's going to either purchase a percentage of the business or have that percentage for a limited time. Would both of those methods apply in the same way? What comments would you have on that type of valuation?
So I'm going to assume that this is a revenue positive business. This is not an early stage company that's looking at investment, because that's very different. That don't even have a valuation. I mean, people, I shouldn't say don't have a valuation. There is a method behind how you set your valuations for early stage investment, and you're required to do that in your offering documents, but that's a completely different thing that has nothing to do with what we're talking about here. So if you're talking about a revenue generating business that is having a value done, then yes, you still can have a calculation of value. Industry specific, I will tell you, like a lot of our health companies, so if you're talking about dentist office or chiropractor's offices or something, they're looking at gross collections. We're looking at a percentage or a multiple of gross collections. I mean, that's really what we're looking at for probably a 3 to a 5 year time frame. I could do that pretty much down to a science. We can look at some of the other risk factors in that, but and there are folks that do specific evaluations to there, but if I boil it down to what everybody ends up talking about at the end of the day, that's it. That is not the science of the full valuation, but that gets you down to the real business of what folks are looking at. Okay, so industry specific, yes, you can still tell them this is for potential investment. Same thing for your buy-sell agreements. I have folks that wanted to do them yearly. It's not a bad idea. They have it as part of their shareholder agreement where, hey, we'll all agree to have someone do a calculation of value for us yearly. So in the event that there's ever death, disability, a dispute, a divorce, we have it. That's a different way of doing it. It's a shortened form. But it really is just starting to get a baseline idea. So all of those things come into play, and there's slight changes based on what you're directing them to do. But
yeah, I mean, if it's like a minority interest or things like that, it's not the same value if I get 100% of it. You know what I mean?
Right.
So there's you know, for example, if I'm buying, if I have the value at 10% interest, a lot of that normalization stuff may not apply because I don't have control. I can't, you know, there's no control over the books. You know, somebody still reigns supreme. So so if somebody was offering me 10% of something, I would pay far less than 100% of something. So all those things need to be, so the whole process becomes different. I mean, all these valuations and anything, however we're looking at it, are very, very specific, case specific, so.
yes, ma'am.
I'm just interested in the cost, like a round figure to have an evaluation.
I mean, typically we'll start around $5,000 and up. I mean,
Is that the same for a calculation of value?
yeah. I mean, it depends on the size and what's going on. I mean, they usually, it can depend, all right? Because here's where the differences come in. You got holding me to a number, but it's like if I get heavily involved in the forecasting, that could really drive the number up because we're not even really doing valuation work anymore, okay? So sometimes some of these other kind of scopes creep in. But I mean, if you want it done right, in my opinion, it's gonna be $5,000 to $7,000, okay? I've done full reports in that range. I've had spent $25,000 in some cases just because the financial analysis piece was so complicated to get to to normalize their income. So.
And then,
Yes, ma'am.
Can we talk about goodwill? So business goodwill versus personal goodwill and how that affects the value of the business?
Well, when it comes to personal versus entity goodwill, obviously entity goodwill is more easily transferable to a buyer, okay? It's General Electric, okay, versus maybe a professional, a lawyer, okay. Now you work for a firm that's known well, but people probably go to Aaron, okay.
That's right. Always me.
All right, not necessarily Dinsmore.
You can find me anywhere.
Yeah, but I mean, like, so that she has personal goodwill, which isn't that if I don't in a lawyer context, I don't even know, you can't even really buy your clients. I mean, you can transition, but it's very hard to transition because all those relationships are with Aaron. They're not with me. Okay, so when you're looking at the value of a business, that can come into play, and it's very important if that's even transitionable I mean, it's more or less if you're looking to buy something when I'm really considering that, but that's kind of the biggest difference. You know, it's easy to transfer entity goodwill. General Electric, like I said, they're great, okay, but it may be hard for you to sell your personal goodwill unless, a lot of times you can combat that issue with good transition planning. You keep that individual on for a while. Maybe they work with you for 2 or 3 years to help get those relationships moved over. And a lot of time I do ask those questions, you know, if you are a company and you're maybe you have a sales guy there and he holds all the keys to everything, right? Okay, you know, and there's a lot of goodwill held with him. So if he's gone again, you may lose all that work, okay? So the entity may have no value because it's all with one person.
But we can incentivize him before you sell your company so that he wants to stay and goes with a new buyer.
Right, no, right.
Can we talk about the actual definition of goodwill versus what you're talking about?
The actual, so,
In other words, so goodwill is essentially, and I've been in a transaction recently where this was the case, where there was an asset purchase and the seller wanted, the assets had a certain value and the seller wanted more money than that.
sure.
And if someone wants to pay for assets or a business more than the assets are worth, the difference between the value of the assets and the selling price is classified as goodwill, which is amortized versus depreciated because it's an intangible asset.
Yeah. For tax
Right,
purposes.
that's
So
right.
if you see an asset sale, you're going to see and actually even in a stock deal, you can do an asset sale allocation for tax purposes. So one of the line items on there could be goodwill, and you put a certain percentage of the purchase price allocated to goodwill.
Yeah, meaning
I
you,
mean, I've seen a lot in the food industry, right? So because, you know, this chef, everybody goes to this restaurant for this chef, and they branched out, and they now have 5 different restaurants, you know, so now they're looking to sell, and they may have created a line of products with their name on it as well. So then it becomes,
Yep.
okay, you have a business, but you have their name too, which is very personalized. So,
Yep.
So for the seller,
Yes.
generally, what is your basis? 0?
for the
For basis, I'm saying for the seller, I'm selling and I sold it for $1 million, so is that, what's my basis?
in your,
For tax
in your
basis.
tax basis and your asset that you're selling,
Yeah,
well, it'd be whatever equity you have in it. Yeah, okay, so if you originally put 50,000 in it and you haven't utilized that 50,000 I mean, if you've been generating income and building basis and not taking the money back out, you know, you may drain the equity every year, which isn't a bad thing necessarily, you know. So your basis could be 0, your basis could be $1 million, you know, if you never took a dime out. It could vary.
But that's a really great question. So any of the tax questions are really great questions because this brings me back to, again, why all your service providers should be working together. Because I'm very clear that I'm a service provider. That is crystal clear in my mind. I think I provide a great service to my clients on their business team, but I get my role. So one of the things that we try to look at with our companies is what does the structure of the transaction need to look like? And part of the consideration is how you currently, basis may come into play. But it's what's the tax impact of this going to look like? That's just one of the factors that we look at. And do we need to reorganize companies before we sold them so that they get a better tax treatment? So it really just depends. But your folks should all be working together is my point.
I mean, there could even be instances where your gain isn't even all capital gain, okay, depending on if you're getting bought out of a law firm, for example, okay, a lot of times part of your buyout includes unrealized assets, meaning it's work in process and things like that. And that could be all ordinary income versus capital gain income. So it could be a blend of both, so.
You also addressed one other really good point that I do. When I do full transaction 101 presentations that really don't focus on valuation much, so poor Brad had to sit with me today on that one. One of the things I talk about is business owners always get purchase price in their head, but they forget that that's gross purchase price and not net. So I really applaud you for even bringing that up because most of folks aren't starting to think through that. And I really encourage people typically when I do those presentations to really think through what they're getting out of this at the end of the day.
Okay, we'll take 1 or 2 more questions. I handed out some evaluations. I appreciate if you could fill those out. You can leave them by the door before you leave, but we'll take a few more questions. Anybody? So is anybody here looking to sell their business right now? Okay. I know we have 1 or 2 people who just sold their companies.
Congratulations, whoever that was.
In the room as well. So, So what would you say, you know, and you can take it both from a legal and accounting perspective, is the biggest downfall people have when they come in? Is it not prepared? Is it the...
Planning can be. I think honestly, we can plan for anything. Listen, we'll figure out where you are baseline, and you tell me how long you have. We'll go from there. I think the biggest hurdle that I face in explaining things to folks is people get very stuck in a mindset. You talk to someone in your industry, and you just assume that this is exactly what's supposed to happen for me. So humor me if you talk to me or any other lawyer that is a true M&A attorney, because they're going to walk you through about 100 different things that probably no one has ever talked to that's specific to you personally and specific to your business that could change what the outcome is for you. So not everything comes in one great big little box that everybody likes tied up with a bow that's the exact same as the person before you.
About Brad?
Well, I've stole mine. I mean, that's a lot of time you have people have these, you know, already decided in their mind, they've read their industry publications and things like that, and they already have a number in their mind. But I mean, from what I do with going through it, I mean, really that financial analysis process is sometimes a bit of a struggle. Sometimes it's not. Some people are great, but sometimes it's very new and they find it to be intrusive. So I mean, sometimes you got to come into it with an open mind about where you are and how I need to get you there, and understand it is a process and there is a lot of critical thinking to it, and it's not. I don't have every spreadsheet I have for every valuation I've done is different for every person. So I mean, I treat it with very, very carefully and critically think about it and analyze things uniquely to everybody. I just don't put it in and print it out on paper and be done with it.
So in terms of time frame, you're looking to sell now, but in terms of time frame, should we be looking a year, 3 years, 5 years? When do we start?
So the industry experts will tell you 3 to 5 years is ideal. And the reason for that is because that gives you 3 to 5 years of financials that you want them to look exactly how they look for a potential purchaser. I have sold companies that have not been looking for that long to sell. They've come in quickly and we've done it quickly. Others have been very long-term clients that they just eventually decided was the right time to transition, maybe to a family member or some other internal management team doing an ESOP or even doing a strategic purchaser that came up in the market. Sometimes market competition, by the way, drives that. You could just say, listen, everyone's getting bought up, now's the time. We've got to go. So then we look at different things. So it really depends. I think the biggest thing is, honestly, takeaway, trust your advisors. So whoever you hire to help you, make sure you trust them, because I will tell you the most difficult transactions for me are the ones where, and I don't say don't question the people, question me all day long. But if I can tell from the very beginning that you just are not going to buy into anything that I have to say about it, I mean, that's why you're paying me, honestly. You're paying me to have an expertise in the field of mergers and acquisitions and to give you that advice. And I will trust you in your business, and you have to trust them enough to tell them everything. So I'll always ask people, what's unique to your business? What's your secret sauce? And you have to trust me enough to tell me the good, the bad, and the indifferent, because I need to assess that and address for it in the transaction to adequately protect you. So even if it's the bad, if it's the stuff that's like, hey, this isn't really industry specific for me, or most other folks don't do this, but we do it this way, just tell me. We'll figure it out. We'll figure out how to put it in the document so it doesn't affect you in a negative way.
Okay, let's give a round of applause. Thank you.